to introduce the session chairman as well as the session speaker, because this was what Mr. Ramdev Buttada, President, had asked me to do. Now, first I will introduce our session chairman, who needs no introduction, whom I know since my CA articles. I know him since my CA articles. He is one of the senior chartered accountant in Twin Cities and a very resourceful person in direct tax laws. He is very humble, decorum, very simple in appearance, stern in his approach, and a treasure of knowledge. He is practicing since many decades. His mark in direct practice is admired by many professionals. He is always helpful and ready to contribute to the cause of our profession with his insights and necessary guidance. In times of adversity, he is always lends his hand to lift the aggrieved from the state of desperation to a new elevated vision of progression. We feel happy to have him as a session of this session, the session of the chairman of this session. Now I turn to introduce our speaker, CA Ramasubramanyam from Bangalore. He is a senior chartered accountant and first class graduate and a rank holder in a CA intermediate and also a rank holder in CA final examination and qualified in 1975. Qualified in 1975. He started his practice. Since he joined employment in BHL from January 76 to July 1978 and started his own firm in 1978 by name MSSP Company, in which he is a senior partner, which is currently in Bangalore. He is mainly engaged in consultation litigation practice in direct and indirect taxes, represented clients before First Appellate and Tribunal, Income Tax Appellate Tribunal, SESTAT, Karnataka Appellate Tribunal. He is specializing in transfer pricing, consultation in tax planning of direct and indirect taxes. The firm MSSV has been appointed as GST consultant for implementation and training by various clients. GST is a major indirect tax initiative of the government, completely changing the scope, ambit, and method of levying indirect taxes. And Mr. Ramasubramanyam is the GST practice head of the firm. He has presented many papers on direct and indirect tax laws in national and zonal seminars and study circle meetings. He is a member of committee constituted by Institute of Chartered Accountants of India to prepare the guidance note on transfer pricing. He is an ex-member of Indirect Taxes Committee of Federation of Karnataka Chamber of Commerce and Industry. He is a director for programs on VAT conducted by Bangalore branch of Southern India Regional Council of Institute of Chartered Accountants of India and Karnataka State Chartered Accountants Society. He is a faculty to Indian Institute of Management Bangalore, Indian Oil Corporation, ONGC, and the list goes on, my friends, because a list is very big. This is only a glimpse of Mr. Ramasubramanyam sir. And with this introduction, I present to you Ramasubramanyam Garu, and I request session chairman KC Devidas Garu to take over the session and lead the proceedings.
Thank you, Sambamurthy, and all the office bearers of the Tax Bar Association, and my good friend, the speaker, Mr. Ramasubramanyam. I have known him for almost 2 to 3 decades now. I can say without fear of contradiction, gentlemen, that is one of the very good speakers on the subject, very knowledgeable, affable, simple. Anytime you can ask, you can just take his email ID and just post questions and the answer will come the next day. I must also equally congratulate the Tax Bar Association for having taken up this topic. Penalties, I would suggest you take up each topic as you have taken now 270A. Then I would also request you to go through 271 AAC. Don't batch all the penalties into one group as you have done today. It's a very interesting topic. The entire provisions relating to concealment of income under 271(1)C has been given a go by. And now section 270 capital A, which has come from the assessment year 2017-18, is concentrating on concept of underreporting and misreporting. You must all be wondering what is this concept of underreporting and misreporting, and they have also defined some of the issues in the context and whether it is all inclusive, exhaustive, or only those limbs will come into. I wouldn't like to make any intrusion into the paper writer's views. Suffice it to say, the penalties have come to stay now. It is very, very difficult now to get out of all these issues. And I would commend to each and every one in the participant here to go through the provisions thoroughly, because you are going to have more and more problems in the penalty proceedings rather than in the quantum proceedings. Now, what was the intention of the legislature to bring in these provisions? Let me tell you from my experience, the department has not succeeded in any of the penalties levied in any of the appellate forums. Mostly they were squashed, so they were finding ways and means. So now they have made the such penalty provisions very stringent. So likewise, they have come to the non such provisions, and that is how section 270 capital A has been formed. So I would, without much ado, just tell you a few concepts. What you have to do as far as the penalty provisions are concerned, you should be very, very strong on quantum. Please do not leave any issue whereby we get caught in the clutches of those 7 items specified in 270 capital A, which the paper right, which Ms. Ramasubramanyam will be taking all of us. But you'll have to concentrate more now. The issues that have come now, as far as these penalties are concerned, more and more onus is thrown on us, and we will have to educate all our clients also about these provisions. Because if we are not in a position to explain the provisions to them, it will be very difficult to tomorrow for them to understand and come to a conclusion. With this short introduction, may I request Mr. Ramasubramanyam. With the short introduction, gentlemen, may I request Mr. Ramasubramanyam to take over the proceedings. I will reserve my comments as and when necessary to the concluding session. If you have the patience, I have the willingness to go through it at the concluding session. But now let us hear my good friend, Mr. Ramasubramanyam. Over to Mr. Ramasubramanyam.
Thank you very much, Devidas. Nice to see you after possibly about 6 to 8 months. I think we met in Hyderabad when I had come for that tribunal hearing. So, and at the outset, let me thank the Telangana and Andhra Pradesh Tax Bar Association for giving me an opportunity to read section 270 capital A. I will not pretend that I have gone through it very thoroughly and I'm mastered the section, because anybody who says that who has mastered any section in Income Tax Act lives in a fool's paradise. So today I have actually made the presentation on 2 topics. One is under section 270 capital A and the other one is on section 271 FA. First, I will take it up with 270 capital A, and what I will do first is that I will give you a brief introduction on the section. What section 271, so 270 capital A subsection 1 to subsection 11 deal with in very brief. I presume that many of you would have read it, but it's also possible that many of you may not have gone through it completely, because the provision came only in from the assessment year 17-18. The notices have started coming under section 274, proposing to levy penalty and 270 only recently. So therefore, you may not, some of you may not have gone through the section. So to make you familiar with the basic law, I'll spend about 15-20 minutes on that. Then I will take you through the issues on that. Then we can have a question and answer session. And if time permits, we will also go into the penalty provision on 271 FA. As Mr. Devidas has suggested, you must have a further program on the other sections in section 271, 272, and to especially the penalties regarding 271 AAB, AAC, and the new section 271 AAD on the false entries, etc. They are all topics of great importance, and we should spend a lot of time trying to understand that. So with this brief introduction, let me just start I'll share the screen from here. First, let me take you through the bare sections of section 270A and 270. As you may know that this was introduced by the Finance Act 2016 from the assessment year 2017-18, both in the budget speech as well as in the circular explaining the memorandum explaining the provisions of the Finance Act 2016. It is stated that the present penalty provision under section 271(1)(c) has become very cumbersome, complex, litigation prone. And in order to simplify and rationalize the penalty provisions, they wanted to replace the concept of section 271(1)(c) with a new concept under section 270A(1). At the end of the session, you can decide for yourself whether the object of the government has been achieved or not. So as you are all aware that under section 271(1)(c), the basic ingredient for levying penalty was either for concealment of an income or furnishing inaccurate particulars of income. So this concept has now been given a go by. The concept says that now section 270A(1) starts saying that any assessing officer, principal commissioner, or commissioner of income tax appeals, or a commissioner during any proceedings can levy penalty for if an assessee has underreported his income. So this is very clear on this. It says that it can be done by the assessing officer, who can be in the rank of a income tax officer or AC or DC or additional commissioner, or the commissioner appeals in a proceeding before him, or the principal commissioner or commissioner in a proceeding before him can levy penalty for underreporting under section 271. This is almost similar to 271(1)(c), which empowered these officers to levy penalty, though in practice, in 99% of the cases, the penalty proceedings are initiated and the penalty is levied only by the assessing officer, and the officers of a higher rank mentioned in the section rarely exercise that power. Now, 270A has been, let's say that it is structured in a particular manner. Subsection 1 says that yes, the officers have the power to levy penalty in the case of underreporting. Then subsection 2 qualitatively defines as to when an underreporting takes place. Kindly note that subsection 2, when we discuss that, it will only describe the circumstances under which there will be an underreporting of income. It has nothing to do with the quantification of the underreported income. Then subsection 3 talks about how do you quantify the underreported income. Then you have subsection 4, which deals with an intangible action made and you justify your investment as a source for based on some earlier disallowances. Then what do you do on that? That is almost equivalent to present explanation 2 to section 271(1)(c). Then you have subsection 6, which says that under what circumstances, subsection 6 would say that under what circumstances the penalty is not leviable, and subsection 9 would say that under what circumstances a portion of the underreported income would be treated as misreporting of the income. Subsection 10 deals with the actual quantum of penalty. So subsection 10 would say that how do you calculate the quantum of penalty? If it is underreporting of income, you have 50% of the tax thereon would be levied as penalty. And if it is misreporting of income, it is on 200%. Then you have the procedural sections on that. So this is the broad scheme. So what you have to understand is this. First, subsection 2 deals in. Kindly, can you please mute, please? Yeah, thank you. Please. Subsection 2 deals only with the qualitative aspect, and subsection 3 deals with the quantitative aspects, and subsection 10 deals with how do you calculate the tax on the underreported income so that the penalty can be levied either as 50% or 200% depending on that. So with this few background, let me go through section by section quickly. What's happening? Sorry, there's some problem in the sharing the screen here. Just for a moment. I'm not able to go to the next one. Yeah, I permitted him to annotate. It's not, annotate, you just leave it. You remove annotate. Sorry for the.
Yeah, full screen can you do, sir? Full screen.
Yeah, it's okay. No problem. There's some issue on that.
Yeah.
So the subsection 2 talks about under what circumstances you will have. One more thing, there are requests for annotation. If I permit annotation, what's happening is there is something happens to my screen. I'm not able to share. I'm not able to go through that, and therefore kindly do not ask for annotation at this moment. There is some problem with my system. Thank you very much. So as far as 278.2 is concerned, it deals with, as I told you, under what circumstances there is underreporting of income. There are about A to G, there are about nearly 7, 8 clauses dealing with that. The first one is that if there is a difference between the assessed income and the income determined as per 143(1)(a), then that will be treated as underreported income. Kindly note here, what is important to note is that it is not the difference between your returned income and the assessed income. It is a difference between the assessed income and the income determined in 143(1)(a). Under certain circumstances, there can be a difference between the two returned income and the intimation income. I will explain the importance of this when I come and discuss the issues with you. The clause B of section 278.2 says that if an assessee does not file the return or files a return in response to notice under section 148, and such return is the first notice. That means, let's say for the assessment year 17-18, you have not filed the return at all. And the income tax officer issues notice under section 148, having come to a conclusion that you have concealed, you have there is escapement of income. Then you file the return for the first time for that assessment year under section 148, then clause B would apply. In that case, if the income assessed is greater than where you don't file the return at all. Let us take the first case where you don't file the return at all. If you don't file the return, the underreported income, if there is a difference between the amount assessed and the maximum amount not chargeable to tax, then there is an underreporting income. This maximum amount not chargeable tax would apply only to individuals, HUF and AOP. So in these cases, if there is a difference between the minimum maximum amount not chargeable tax and the assessed income, there is underreporting of income. But in the case of a company or a firm where there is no minimum exemption at all, in those cases, whatever will be the assessed income, there will be a difference, and that will become the underreported income. Similarly, when you file a return under 148, it is for the first time. The next subsection is that suppose you have been assessed first time under section 140, an assessment has happened. Later, a notice under section 148 is issued for a reassessment under section 147. Then, if there is a difference between the reassessed income and the last assessed income, then there can be an underreporting income. As you are aware, there is also possible that you can have more than one reassessment subject to limitation. So let us assume, say, for the assessment year 14-15, there is an original assessment under section 143.3. Then another first reassessment takes place. Then it is also possible a second reassessment can take place. So with reference to the first reassessment, the difference between the income determined in that reassessment order and the 143.3 assessed income, if there is a difference, that there will be underreporting of income. When it comes to the second reassessment order, they will look at the income determined in the second reassessment order and compare it with the income determined in the first reassessment order. And if there is a difference, that difference would be treated as an undisclosed income. When I say there's a difference in all these cases, the difference should be more in the sense that there should be further additions to the earlier assessed income. If it's obviously reduced, there is no question of levying penalty on that. Then the third issue is that in respect of 115 JB income or 115 JC income, that is minimum alternative tax or alternative minimum tax on that. So in the case of these things, if there is a difference between the returned book profits and the assessed book profits as determined as per the provisions of 143(1)(a), then there will be an underreporting of the income. So you have your book profit in the case of a company. Let us say that you have returned something. There is an intimation given to you under 143, not intimation. Let us say that there is a process of determination of total income under 143(1)(a). You have that figure. Then an assessment takes place. If in the assessment the book profits are determined at greater than what was determined at 143(1)(a), that there will be an underreporting of the income. The next situation is the mirror situation of where you don't file the return, or the return has been filed in response to notice for the first time under section 148. What happens in the case of book profit? It is identical to the book profits, the normal regular income as for that, and there is no difference at all. It is only the book profit taken into account under clause B and clause E, whereas under clause A, clause B and clause C, it is the assessed income under normal provisions compared to the income determined under 143(1)(a). The next one is where the income assessed or reassessed has the effect of reducing the loss or converting a loss to such income. For instance, you may have filed a return claiming loss. In the assessment or in the reassessment, such loss is varied to your prejudice in the sense that loss is reduced or the loss is converted in income, then also there is underreporting of the income. So these are the 7 situations where there can be underreporting of income, which are listed in section 270A to A to G, subclauses A to subclause G. So these are the 7 sections. Basically, what you have to understand here is that except in the case of the reduction in loss or loss converted income, in all other cases, the comparison is not between the assessed income and the returned income as it happens under 271(1)(c) now. The comparison is between the assessed income and the income as computed under section 143(1)(a). So under these circumstances, there will be an underreporting income. So first is you see whether there is a difference, and if there is a difference, then we look at the underreporting of the income, how to quantify that. This is now given in subsection 3. So look at it in subsection 3. What they have done is they have divided into 2 parts. A particular assessment year. Let us say for the assessment year 18-19, you have filed a return, a notice under 143(2) is issued, and an assessment under 143(3) is made. Then that 143(3) assessment is the first assessment or assessment for the first time for the assessment year 18-19. You might have been assessed in the earlier years, that doesn't matter. So don't confuse the expression where income has been assessed for the first time with whether you are a regular assessee or not. That is not the issue. The issue is whether you have been, that for that particular assessment year, have you been assessed for the first time. That there have been no assessment under 143(3) earlier, so you are doing it for the first time. Then what it says is if the return is furnished, the difference between the amount of income assessed and the amount of income determined under clause A of 143(1). So here the quantification comes. Suppose let us say that the assessed income under section 140 lakhs and the income computed in accordance with 143(1)(a) is 8 lakhs. Then they say that there will be an underreporting of income of 2 lakhs. So this is something where it comes for the first time, because this is the first time you have been made an assessment of 143 has been made for that particular assessment year. You have furnished the return and this will be under. Now the second thing is where you have been assessed for the first time, but you have not filed the return at all. How it can happen that you have not filed the return, still there can be an assessment for the first time on this. Then it can be due to the fact that a reassessment procedure, not a reassessment, an assessment under 147 taken for the first time. Then they say that how do you compute that? The amount of income assessed in the case of a company, firm or local authority. So in the case of a company where you have not filed the return, and if an assessment under section 144 takes place, or he has issued a notice under section 148, and that notice happens to be the first time you are filing a return in response to the notice, you have not filed your return voluntarily under section 139 under before, then in these 2 cases, this subsection will apply. In this case, it says that in the case of a company, whatever income which has been determined under section 144 or under section 147, as the case may be, will be the underreported income. That means if you don't file the return, the whole of the assessed income becomes your underreported income in the case of non-individuals, HUF, non-HUF and AOP cases. When it happens in other cases, what will happen is where the difference between the amount income assessed and the maximum amount not chargeable to tax. So here is a case, let us take an individual. That individual has not filed the return. Let us say that even he does not respond to a notice issued under section 142(1) to file the return. An assessment is made on him under section 144, determining the total income at 6 lakhs. And let us assume that the up to 2,50,000 is the maximum amount not chargeable to tax. The underreported income is 3.5 lakh. Please note, in this case, the underreported income is not 6 lakhs. The underreported income is 3.5 lakhs, which is 6 lakhs minus 2, which is the assessed income. 2.5 lakhs is the maximum amount not chargeable to tax. So therefore, that's. Is this clear? I would like one more thing. In case you have certain doubts, I don't want to stop you there. I don't want to wait until the last moment. But as long as it doesn't interrupt the flow much, you can ask the doubts even in between. I have no issue as long as the Tax Bar Association has no issue on this. Is it okay?
This stage, let me come in at this stage. If you allow questions to be posed at the point of time when you are, definitely your flow of thoughts will go. I would suggest each one of the delegates to make a note of the questions involved and then put it in the end. Once you throw it open at each stage, everyone will start asking questions and your flow of thoughts will be jeopardized. So therefore,
thanks, Devidas.
I'm sorry, I'm overruling you on this.
No, thank you. You are always over. I don't think you have ever agreed with me. Thanks. I think that's a good suggestion. No problem. We'll follow that. The chairman's ruling is final. So in another cases, let us assume, as I told you, you can also have a situation where an assessment has been made earlier under section 143.3 or a reassessment or an assessment under section 147 for the first time has been made, or a reassessment has been made under section 147. These are the various situations which are also covered in the qualitative aspect of the underreporting of income. So in such cases, what they say is that if in the latest assessment or the reassessment order, the amount of income, the total income determined is greater than the amount of total income determined in the preceding order, then you have the underreporting income, which is equal to that figure. Let us assume that there is an assessment under section 143.3 earlier. The income determined is 20 lakhs. Then there is a notice under section 148 is issued, and the assessing officer makes an assessment under section 147 determining your income at 30 lakhs. So here what they will compare is this 30 lakhs they will compare with the earlier determined figure of 20 lakhs, and then they will say the difference of 10 lakhs is the underreported income. So on this basis, the quantification of the underreported income takes place. See, there is many of you are aware that in the case of a determination of total income under section 115 JB or 115 JC, what happens is the book profit completely overtakes the income determined under regular provisions of the Act. The book profit replaces the book profit shall be deemed to be the total income, and on that total income, the tax at the rate of 18.75% is taxed, with plus such charge is being levied. So what will happen is that in the context of penalty under section 271C earlier, there was a case where in the regular computation, the officer made some additions. Let us say that I filed a return of income showing that tax is payable under the book profits. The tax payable under the book profit as per my computation, let us say, is 100 lakhs. I also need to compute my regular income, which I have done at, let's say, 70 lakhs or 60 lakhs. The assessing officer, what he does is he makes an assessment and says, while computing my regular income, make some disallowances and computes my regular income at, let's say, at 75 lakhs. But my book profit is 100 lakhs, and let us assume the tax payable on book profit is more than the tax payable on the recomputed regular income. So what happens? The finally assessed total income remains the same. There is no difference. I have returned a book profit of 100 rupees, paid tax on that. The assessing officer also in the assessment order finally determines that I am liable to pay tax only on the book profit. He doesn't make any adjustment for that. He accepts your taxes. Your book profit is 100 and taxes will be paid accordingly. So in this case, what happens? Legally speaking, there was absolutely no addition to total income. So the definition of the concealment of income or publishing inaccurate particulars in 271(1)(c) would not apply because there is no addition to total income at all. You returned in total income and the assessed total income is same. Under these circumstances, the Delhi High Court said that you cannot levy penalty. What the assessing officer did in that case was that while computing your regular income, I have added X amount. That X amount is because of concealment of income or because of furnishing of inaccurate particulars of income. So therefore, what he said is that I'm going to levy penalty on that amount. The assessor's contention was that there is no difference between my returned total income and finally assessed total income because both I have paid tax on book profits. The officer has also accepted that I'm liable to pay tax only on book profits and not on my regular income, and therefore no penalty can be levied. So therefore, there was a dispute and the High Court decided the case in favor of the assessor. So to get over the decision of the High Court, the explanation was added in section 271(1)(c) as to how to deal with these kind of cases. The explanation basically says that you have to take the additions made under both methods of computation. In the example, you have an addition which is under the regular total income. That addition also you take. You also take what are the other additions made while making the computing the book profits, and then levy, find out what is the concealed income and levy penalty accordingly. So what happens, even though there is no addition to the book profit, there are some additions to the computation under the regular method, and therefore on that addition, though you are not liable to pay tax, you are liable to pay penalty if it is assumed that it is amounts to concealment of income or furnishing of inaccurate particulars. So this is the formula which was given in that 271(1)(c). Same formula has been adopted here. What they say is formula is A minus B plus C minus D. What is A? A is equal to total income assessed as per the provisions other than the provisions contained in 115 JB called a general provision. Let's say under regular method, the total income assessed is, I will just read the example from here. I will, because I have not made a slide for that, so I'm not able to. Let us assume that the assessed regular income is 60 rupees. The returned regular income, let us say, is 40 rupees. So there is an addition of 20 rupees. Again, let us assume that this 20 rupees consists of two portions. One is 5 rupees where you have debited the income tax to the profit loss account, but did not make an adjustment in your computation of income. You claimed it as a deduction. The officer rightly disallowed it. Let's say that is 5 rupees. You have other disallowances, 15 rupees. So the total disallowance is 20 rupees. So he determines the regular income at 60 rupees. Now let us say that you have returned a book profit of 125 rupees. And you have paid tax on that because the tax on book profit is more than the tax on regular total income. And he increases it by another 15 rupees to make it 140. So in this 140 also consists of two components. One component is, let's say, that 5 rupees which you are debited to income tax, debited to the profit loss account. The income tax amount debited to the profit loss 5 rupees plus 15 rupees, let us say, a difference in some carry forward depreciation or loss, whichever is less. There is a difference between the department records and your records, and therefore he adds another 10 rupees on that account. So totally he adds 15 rupees to the book profit, and he says I'm levying tax on 140 rupees. So in this case, what happens? Normally A minus B will be is the return assessed regular income under normal provisions of the Act. That in my example is 60 rupees. The returned regular computation is 40 rupees. So the difference is 20 rupees. Then C would normally be the assessed book profits by the assessing officer, that is 140. Then D would be the returned book profit, which will be 125. So what happens? The concealed income would be A minus B, that is 60 minus 40, 20, plus 140 minus 125, 15. So total is 35. This is what the formula says. But formula gives one exception here. Here in the example I gave you, there is a common element. That 5 rupees income tax which has been debited to the profit loss account, which are claimed as a deduction both under, well, computing the income under the regular provisions, as well as the computing the book profit, has been disallowed twice. So what they say is, if certain things like these common disallowances are there, remove this amount from D. So what will happen is, in the example, it will be 60 minus 20, 60 minus 40. A minus B is 60 minus 40. That doesn't change. C of 140 does not change. But here what they say is, instead of saying 125, they say this 5 rupees is common disallowance. So remove 5 rupees from 120. So that will become 140 minus 120. That will be 20 rupees. So what will happen is, your underreported income will be A minus B is 20. C minus D as adjusted is 10. Total is 30. So what happens? Earlier it was 35. Now it is 30. So why this is given? Because they say that once, if there is a common disallowance, we don't want to consider it twice for the disallowance for levying penalty, because already we are levying penalty on that 5 rupees under A minus B. So we don't want to levy penalty on that 5 rupees again under C minus D. Okay, this when I come to the issues, I'll take up that through that. I'll give some examples so it will be very clear on that. And there is a definition of the preceding order, which, as I told you, as I explained to you earlier, that in the case of where an assessment has been made earlier already under 143.3 or under section 147, there is a difference. If there is a further reassessment, then the difference between the last reassessed figure and the earlier order is to be taken into account. They say what is preceding order. That preceding order is defined here. When I take you through the issues, you'll be able to see the quantification of that. Then it says that in the case of a reduction in loss and in the case of a loss converted into an income, how do you compute the underreported income? What they are saying in such cases is that if there is a reduction in loss, that reduction is deemed to be the underreported income. If there is, if it is otherwise that if there is conversion of loss into income, it will be loss plus income will be the underreported income. This is what this clause B of the explanation says that. This is very simple. There is no issue on this. Okay. Then subsection 4 is, what happens is, we normally, if there are some intangible additions made in a particular assessment year, okay, and then in the subsequent year, if there is an investment I have made and I have not accounted in the books, I have to explain the source. So what many assessees would say is, you telescope the additions which were made in the earlier year, the intangible additions you had made, the earlier assessments was available with me, which is not recorded in the books. And therefore, this is the source. So what the government said was that once he explains the source for this, as this one, anyway, this year he has explained the source, so no addition. But this has come out of some concealed income, and therefore there was an explanation added to section 271(1)(c), which said that if no penalty was levied in the earlier year for such addition, and if you say that that addition is a source for an investment in a subsequent year, then the department can levy penalty for the earlier year. So is that clear? So if you say that an addition made in the earlier year is the source for an investment made in a subsequent year, and if no addition has been made in the earlier year, no penalty has been levied in the earlier year, then the department, by invoking this explanation, can go back to the earlier assessment year and levy penalty. So this concept has been brought into subsection 4 in respect of underreported income. Next we have is that how do you compute the underreported income in respect of this year covered by subsection 4. What I will do is when I come to the issues, I have a slide on that. On that slide, I will let you know given the examples that will make them very clear instead of telling you now and then repeating it there. Only one thing is that Ms. Devidas, can I, how long I have so that I will do it accordingly? Up to? When do we close the meeting?
What was it, Ram?
When do we close the meeting? How long I have time?
We can have around 45 minutes more, sir. We started the meeting at around 3, sir. So we can have maximum 2.
Actually, the lecture started at 3:30.
Yes, it got. So we can have around 1 hour more, sir.
So
Wow.
I'll request you to, bear with me and
Yes,
maybe
sir.
up to 5. Is it okay?
Yes, sir. It's okay.
5 o'clock, another 1 hour?
No, make it
Yes, yes.
make it 5:15 and 45 seconds. That will be fine.
No, I have an objection. I'll make it 48 seconds.
Okay, right.
Right. Fine. Thank you. So what happens is that this subsection 5 deals with a case where you have how to quantify the underreported income in the case of that. Okay, so that we will see it when we come to the slide. Then this is a very important section. Subsection 6 is very important because this is where we are able to, if you are able to justify, then the penalty cannot be levied by the assessing officer. So it is very important to know that we fall under these, what are these various clauses and what are the various options available to us to ensure that our client does not suffer a penalty. The first one is that you can say that the addition made in the assessment order is due to a bona fide reasons. It's due to there is a bona fide mistake, or I have made a bona fide claim and you have not agreed with me and made a disallowance. This is the principle laid down by the Supreme Court in Reliance Petrochem case, where they said that just because an addition is made, you can't assume it's a concealed income. If the assessee has made a bona fide claim and the department does not agree with such a claim and adds that amount to the assessed returned income, there is no question of any concealment. So this principle has been laid down in 270 capital 6 clause A, subsection 6 clause A. Then you have the clause B. See, sometimes what happens is that you have filed a return determining your income based on certain method of accounting followed by you. Okay. So though it is not permitted under this one, let's assume for the sake of argument that you have followed a hybrid system of accounting. In respect of expenses, you have followed mercantile, and in respect of the income, you have followed cash basis, and you have prepared the profit loss account accordingly, and file the return also accordingly. Now, in this case, what happens is that the officer will reject this method of account because this is not permitted. He can also reject the method of accounting if it is not in accordance with the law or the income cannot be determined properly under as provided in section 145 subsection 3. So under these circumstances, the entire method of accounting can be rejected and the income can be estimated on the basis of the correct method of accounting, either cash system or mercantile system. So if the officer does that, and if there is an addition due to that, then there is no underreporting of income. Here you don't have to prove anything. You have to prove only one fact, that you have rejected my method under section 145(3) and determined the income by estimating, and then therefore you are not to treat that extra amount which is added to my income as underreported income. The next one is where you have on your own, on the basis of certain estimates, has disallowed certain expenses. The most common thing which you used to do in many cases is that in the case of a firm of a proprietary concern, the car running expenses, maintenance expenses, depreciation on car, etc., we used to disallow. In the assessment, let us say the assessing officer says, no, it is not 15%. According to me, it is 25%. So he says, I'm going to disallow 25% of the car maintenance instead of 15% which you have yourself disallowed in the return. So under these circumstances, there will not be any underreporting of income. The next one is a case where a TP addition. If there is a TP addition on account of international transaction, then and you had maintained the proper information documentation which is required under section 92D of the Act, you have obtained all the audit report which is required under 92E, etc., and filed everything. The only thing is that the officer rejects your documentation and says that the ALP determined by you, I am not accepting. I am doing my own research, and this is the fresh ALP. On that basis, I'm making this adjustment. And if he makes this one, then also there is no underreporting of income. But it is important to note that this provision is only in respect of international transaction. Where there is a specified domestic transaction, which is also subject to TP, and if an adjustment is made to your ALP determined by you, and say that, and the officer adds something more in respect of a SDT, this clause is not applicable. So if in case of SDT, if you want to say that yes, the addition is there, you want to justify it, probably you have to go back to clause A, which says that you have made a bona fide claim and it has been disallowed. So you have to prove with the evidence that your claim is proper. The next one is, of course, this is clarificatory. Under section 271 AAB, in the case of a specified years, the case of a search, that is the year in which the search takes place and immediately preceding assessment year, the section 271 AAB provisions are applicable, and it says that how do you determine the penalty for those two assessment years. So since section 271 AAB, etc., deals with those sections for those two specified years separately, it will not apply to section 270A. It is only clarificatory in nature. There is nothing much on that. Next we come to subsection 7 and subsection 8. it refers to the quantum of penalty. The quantum of penalty in the case of an underreporting income is 50% of the underreported income. If the tax on underreported income is 50%. As I told you earlier, how to calculate the tax, that is given in subsection 10. So subsection 7 says that if there is an underreporting income, then normally the penalty is equal to 50% of the tax payable on such underreported income. Then subsection 8 says that if the underreporting of income amounts to a misreporting of income, then the penalty is 200%. There is no discretion vested with the assessing officer to levy a lesser penalty than 200%. For instance, today in 271(1)(c), there is a bandwidth is given between 100% of the tax and 300% of the tax on concealed income. But that bandwidth is not available to the assessing officer when he wants to levy penalty for misreporting. It is straightforward 200%. Either it is 0 or 200%.
Oh,
So there is absolutely no via media in this. You can only say that, yes,
sorry.
it is not a misreporting of income. It is not misreporting of income at all, and it is therefore it is not 200%. It's only 50% because it's underreporting of income. But once it is established that it amounts to misreporting, then there is no option for anybody to levy a penalty less than 200%. And subsection 9 deals with what are those cases where a misreporting of income takes place. One is this misrepresentation or suppression of tax. This is an expression taken from the indirect tax like central excise, service, Finance Act relating to service tax, or the present GST provision. Misrepresentation or suppression of facts. Then the second point is failure to record investments in books of account, claim of expenditure not substantiated by evidence, recording of any false entry in the books of account. There is an interesting issue because when the section was introduced for the assessment year 17-18, there was no section 271 AAD. As you know, section 271 AAD levies a separate penalty for making false entries in the books, and that section was introduced by the Finance Act 2020, and therefore there is a double penalty under this. I have not discussed this in the slide in the presentation because it was not there at that time. So when we take up the issues, we will also see the interplay between section 270A9 and 271 AAD. And if you fail to record any receipts in the book having an implication on income, then you are liable. It will be treated as a misreporting of income, and penalty will be levied accordingly. Then, if you fail to report any international transaction or any transaction deemed to be an international transaction or a specified domestic transaction, then that will also be misreported income. A mere failure to do this. We have some interesting issues on subsection 9 on misreporting of income, which we will discuss on the issues. Again, subsection 10 deals with the quantification of tax on underreported income, because what is the quantum of penalty? Either it is 50% of tax on underreported income or 200% of the tax on underreported income. So how do you quantify the tax on underreported income is provided by section 10. I have given in my slide an example of how to calculate this. So when we read those, when we check that example, we'll be able to understand it rather than I trying to explain it in abstract. It'll be much better if I explain it to you with figures so that you'll be able to understand it much easily. Section 11 is, I don't know why they have put this section at all. They say that if no addition shall form part of an underreported of income or a misreporting of income, if already penalty had been levied earlier on such. So therefore, there is no need for this, or that is quite obvious. And the last one says that the authority who is going to levy penalty has to levy penalty by an order passed in writing. Okay. The immunity section, I'll come a bit later under 220 WA1 after finishing the issues on 270A. On the first issue regarding satisfaction, I'll come to a bit later. Before that, I'll take. So here I take this. It's a very interesting issue which you have to understand. Look at the language of section 270 capital A. What it says is that the assessing officer, principal commissioner, commissioner of income tax, etc. During any proceedings may direct that a penalty shall be levied on the assessee on if there is underreporting of income. This is, I am paraphrasing it. But it is important to note that the expression used is the authority concerned may direct during any proceeding before him. This is very important note. Contrast this with section 271(1)(c). What section 271(1)(c) requires is that during any proceeding before him, he should be satisfied that the assessee has concealed the income or furnished inaccurate particulars of income. Then if all it requires at that stage is only a satisfaction should be reached at the assessment during the assessment proceedings, and afterwards he will initiate penalty by issuing notice under 274. Consider your reply and levy penalty under the appropriate section. This is the procedure under 271(1)(c). But you see 270A1. It looks as if that the assessing officer should levy penalty along with the assessment order. I'll just read section 270A from here instead of going back to that slide again, because this is, I expect there might be quite a bit of discussion on this. What it says is the assessing officer or the commissioner of appeals or the principal commissioner or the commissioner may, during the course of any proceeding under this act, direct that a person who has underreported his income shall be liable to pay penalty. So the direction to levy penalty should happen during the course of the proceedings. Obviously, the proceedings before the referred to in section 270A1 have to be only assessment proceedings, because even section 271(1)(c) uses similar expression, and there are a couple of decisions by the Patna High Court and the Punjab and Haryana High Court saying that the assessment, the proceedings referred to in section 271(1)(c) refer to assessment proceedings and not any other proceeding, because only during assessment proceedings you compute the total income, and only during computing the making the assessment order you will come to know whether there is underreporting of income or misreporting. So therefore, since during the proceeding itself he should direct, there is a view that can be taken is that he has to pass the penalty order along with the assessment order. This looks very a startling proposition. I am only making this as a point for discussion. I am not categorically saying that it will happen. But my point is that we have to develop the law on this issue because it might be one of the defenses available. For instance, until say about 4 years back, we never used to bother about 274 notice. We never used to read the 274 notice. Suddenly, after the Karnataka High Court said in Manjunatha Cotton, saying that if the assessing officer does not strike off the concealed the particulars of income or furnished inaccurate particulars of income, if he does not strike one of them, then the penalty cannot be levied. The notice is bad in law for being vague. Nobody thought about this. But some lawyer, somebody or some chartered accountant thought about this because possibly the case on merits was very weak. He took up this issue and today almost it has become the law. There is hardly any decision contrary to this except one Kerala High Court judgment. All the other high courts and the tribunals across the country are following this Manjunatha principle. So on this technical ground, the penalty is being quashed. So we should try to develop this technical argument and see whether if it is right. Academically speaking, there is a problem on this. The reason is that it may lead to impracticality. See, unless the assessing officer completes the assessment, he can't determine the total income. He can't do anything on that. He can't determine the underreported income, determine the misreported income component, etc. Then most important thing is you have the section 270AA, which we will discuss it later. But briefly, section 270AA says that after the assessment order is passed, you pay the tax and interest determined in the assessment order within the time allowed under the notice under section 156. That is normally 30 days. And you don't file an appeal against the assessment order. You can make an application to the assessing officer to say, please grant me immunity from penalty. The assessing officer can grant you immunity from penalty provided the additions do not amount to misreporting of income. And if it's a mere underreporting of income, you will get the immunity. If you satisfy these two conditions, that you have not filed the appeal, you have paid the taxes and interest. So therefore, on this issue, so the question is, if you have to necessarily wait for the completion of the assessment order to make an application under 270AA. If my argument that penalty order also should be passed along with the assessment order, where is the question of immunity? Then the section 270AA becomes illusory. It doesn't, according to somebody, it is totally impractical to do that. So if you look at that way interpretation, possibly one can take a stand that my earlier proposition of law is not right. The penalty order can be passed later. The expression may direct during any proceeding before him has to be read contextually and in a practical manner. This is one way of looking at it, saying countering the argument. A counter to this argument would be that, no, there are 2 points. On 270AA, I would say that even if he passes a penalty order along with the assessment order, I can make an application on 270A and saying that I have complied with those sections and therefore withdraw the penalty. The granting of immunity includes waiver of penalty. It is because there is a difference, because waiver means something has happened and then you waive that. Immunity means that the proceeding itself are not initiated. When I say please grant me from immunity from levying penalty, means normally you don't initiate penalty proceedings, or if you have initiated, don't levy penalty. Waiver means somebody has levied penalty, please waive that amount. So this is the concept. Though the expression used in section 270AA is immunity from penalty, we can say that contextually it would include this. Then the second important point is that there are a host of Supreme Court judgments on penalty. They say that penalty, the wordings in section have to be distinct and clear. There cannot be any ambiguity in levying penalty. If there is any ambiguity in law in respect of penal provisions, that ambiguity has to be resolved in favor of the assessor. So following this principle of interpretation, we can still say, yes, if he doesn't do it, the penalty is not leviable. Practically what happens, and with your permission, I'll have some tea, please, if you don't mind. Okay, practically what happens is that in many assessment orders which you have received for 17-18, the assessing officer simply issues a notice under 274 saying that why penalty under 278 should not be levied. He does not pass the penalty order along with the assessment order because they think that it's a separate proceeding. So this is a very interesting issue which one has to think and develop the law. As I said earlier, I am just articulating both the views. So it is for you to decide which view you want to take. And my point is that even if you don't agree with me, or even if you don't agree with the first proposition, in an appeal, you can always take this point because there is no such thing as I don't argue on a point in appeal because I'm convinced of that point. I argue because I want to protect my client. So I will take any contention, however atrocious or outlandish it may be, and who knows, it may strike the judge very favorably and he may hold in my favor. So therefore, as far as the argument before the appellate authorities are concerned, we shouldn't bother about whether it is right or wrong. We can take a stand like this and then do it. Maybe at the CAT appeals level, not 100% you won't agree. At tribunal level, you have a chance. And similarly, at the High Court and Supreme Court level, and possibly you may also have an amendment to the Act later. Okay. So the stage at which the penalty should be levied is whether it is at the assessment stage itself or at a later stage is a matter of debate. So this slide is just, I explained to you the 270A. So though I have said finally the reasonable view is that penalty under section 270A can be levied by a separate order after passing the assessment order. This might be a reasonable view, but you have to be very clear that in an appeal, if you can take this ground and argue that point. Then let us look at the issues arising out of 270A subsection 2. I have made a mistake in this. You see, I have written here, underreported income is the difference between the assessed income and the income determined under 143(1)A intimation. That please remove that intimation. There is no, the intimation is not issued under 143(1)A. The intimation is issued under 143(1)C. By mistake, this intimation has come. So that intimation is not there. It is just a computation of total income in accordance with provision of section 143(1)A. Okay. And as I explained to you in the beginning itself, it is not difference between the assessed income and the returned income. It is assessed income and the income computed in accordance with provision of section 143(1)A. So if there is an addition in 143(1)A, 143(1), there can't be a penalty just because of that. Income assessed also will include income assessed under 143(3), 144, etc. Now there can be a very interesting situation where the income assessed under section 143(3) is less than the income determined under 143(1)A. We'll take a very simple example. What has happened? There is a returned income of 2 crore. While filing the return, you have set off the carried forward loss of 1 crore, which is in dispute. Though the assessing officer has disallowed some figure, reduced your loss in early area, you are in appeal. So what you have done is you have taken the carry forward loss as per your computation and deducted that 1 crore from your total income and filed it. So in the computation under section 143(1)(a), what will happen is that there will be a addition to that because it is not proper, because it automatically processes and say that as per the earlier assessment order, no carry forward loss is there. You have claimed 1 crore and therefore we are going to add back that and make it as 3 crores. By the time the assessment is completed under 143(3), let us say the appeal order is in your favor. The assessing officer will allow that 1 crore. But what he does is he makes some other addition of 50 lakhs. So he determines your total income at 2.5 crores. So now you don't compare your 2.5 crore with 2 crore of the returned income. You compare the 2.5 crore of the assessed income with 3 crores determined under 143(1)(a). Since the amount assessed under 143(3) is not greater than the amount determined under 143(1)(a), there is no underreporting of income at all. So this is one interesting issue. In fact, we have got some practical assessment orders. What happened was while framing 143(1), what they do is they add back all the ESI and PF contributions, which are employees' contribution, etc., which are not paid within the due date as per that act, but paid before the filing of due date for filing of the return. This happens automatically because of the program. But when an assessment under 143(3) comes, we make a submission before the assessing officer that as per the Karnataka High Court judgment, this is allowable as a deduction. And he follows that High Court judgment and says, yes, I am allowing that. So therefore, in this case, what happens? And he makes some other additions. But the total income as per 143(3) is less than the amount determined under 143(1)(a). Then there is no penalty because by definition of income. Is that clear? Yeah. Okay, this I have already explained to you earlier, so I don't want to repeat that. Now, there is one issue on the loss. This is a conceptual issue. Again, we'll go back to subsection 2 of 270A. I will read that relevant portion, which is with reference to loss. Clause G of this one says that the income assessed or written has the effect of reducing the loss or converting such loss into income. Now, if you read only 270 capital A subsection 2 subclause G, it does not talk about what is being compared with what. It says if the assessment order reduces your loss, what is that loss? Is it the loss which is determined in accordance with 143(1)(a), or is it the loss as per returns? This is the issue. They don't use the expression loss claimed in the return or loss determined in accordance with section 143(1)(a). So this being the position, this is not very happily worded, this clause G of 278 2G. 2G is a bit difficult, but when you come to the explanation below 278.3, it tells you the quantification of the loss reduction case or loss to income cases. It says how to quantify that. There they are using very clearly in a case where an assessment or reassessment has the effect of reducing the loss declared in the return. So the explanation clause B below section 278.3 says that while quantifying this, they are comparing the assessed loss and the returned loss. So the question is whether for the purpose of section 278.2 subclause G, also you take into account only the returned loss and not the loss computed under 143(1)(a). This is because of the issue. This is a highly interpretative issue. We can justify both the stance on any known principles of interpretation. One of the fundamental principles of interpretation is that you should never read the two sections in a taxing statute, especially, to be in conflict with each other. It is a duty of the judge to harmonize and say that this is how I reconcile these two sections. So therefore, since the explanation says for the purpose of this section, in the case of a loss reduction or loss to income case, this is how the quantification of the underreported income will take place, and that underreported income is quantified on the basis of the returned loss and not on the loss computed under 143(1)(a). So therefore, you juxtapose this explanation into 278(2)(g) and say that for everywhere you have to compare only the return loss. One counter to this is that this says this explanation is for the purpose of this section. Though it says this section, in the context, the explanation will apply only to 270(a) subsection 3, because it explains the various terms used in 270(a)(3), like the preceding order. Preceding order is used only in 270(a)(3). So therefore, even this loss to loss should only be in the case of 270(a)(3), but it will not impact 270(a)(2). So there is a conflict in the qualifying clause. There is a vagueness, there is ambiguity, whereas in the quantification clause, it is clear. So one way of looking at it is you harmonize both and take the quantification clause, read that into the qualification clause, and say penalty can be levied. The other is that, as I told you, based on Supreme Court judgments, once there is ambiguity, that has to be in favor of the assessee, resolve it in favor of the assessee. Since this cannot definitely fall under, one cannot say with a certainty that this kind of a loss reduction falls under the definition of underreported income in 270(a)(2)(g), penalty cannot be levied, is one possible interpretation. It is for you to think on this and then take a view. See, one very interesting issue, if you look at the quantification of 270(a)(3), when I explain the example, you will understand it better, is that it looks as if you don't file the return, your quantum of underreported income is less. If you file a return and if there's an addition is made, and assuming everything else, the total income is identical, the additions are identical, etc., then you will find that the quantum of underreported income is less in the case of a person who does not file the return. This seems to be a lacuna, but it is not, because I'll explain to you later. Take this example. The return income is 1 lakh, assessed income is 3 lakhs, the underreported income is 2 lakhs. There is absolutely no dispute on this, because your returned income of 1 lakh, assessed income is 3 lakhs, and therefore it is 2 lakhs. Fine. Take a case where the assessed income is 3, not filed the return. Order under section 144, best judgment assessment has been passed. You have an assessed income of 3 lakhs. When you have an assessed income of 3 lakhs, section 270(a)(3), what it says that the assessed income in excess of the maximum amount not chargeable to tax is the underreported income. So here, what is the assessed tax? Assessed tax is 3 lakhs. what is the maximum amount not chargeable tax in the case of individual or HUF, etc., or a AOP? The non-specified AOP is 2,50,000 rupees. So the underreported income is 3 lakhs minus 2,50,000. It's only 50,000. Look at, otherwise everything is same. In fact, this person has at least filed a return, and addition only is 2 lakhs. Technically, in the second case where he has not filed the return, the addition is 3 lakhs. But in the case of an addition of 3 lakhs, the underreported income is 50,000 rupees. When you file the return, it is 2 lakhs. Prima facie, this looks like absurd, but it is not, because what happens when it comes to the quantification of the tax on the underreported income, they make an adjustment to this 50,000. I'll explain that. There, what they will do is, while computing the tax on underreported income, they will say the underreported income should be increased by the maximum amount not chargeable to tax. So, while calculating tax, what they will do is, they will make it 50,000 plus 2,50,000, make it 3 lakhs, find the tax on that, and that will be the tax on underreported income, which will be exactly equal to tax on the your underreported income in the first case. We'll see an example when we come to the, I will come back to this slide again when I explain to you the subsection 10, which quantifies the tax on underreported income. Please, another issue which I would like you to think is that what is the status of a return where the total income computed is less than the maximum amount not chargeable to tax? You must review this question in the context of the legislative history. There were decisions earlier saying that once you file the return, okay, then that return is a valid return. The income tax officer cannot ignore it. Then we had section 139 subsection 10, which was introduced and which was there in statute book for about, I think about 7-8 years. Somebody can correct me, I don't remember the exact. 139.10 was there, and that 139.10 said that if you file a return which shows the total income less than the maximum amount not chargeable tax, and if there is no refund, if there is no prepaid tax, then that return is non-est. But then they removed section 139.10. So in this context, suppose I file, as in the example I had given you, I had filed a return of 1 lakh. Can there be a processing of this return under 143(1)(a) at all? Can this return be treated as a case where you have not filed the return at all? So that could be one issue which can be discussed, and then a view can be taken on this. Whether it has a practical impact or not is a different issue, but legally speaking, it can have a different impact. So now let us take a case where multiple assessments have been made. Now let us say first an order under 143 is passed. The income determined is 10 lakh. Then there is a first reassessment order under 147. Income determined there is 12 lakh. Then there is another assessment order. Income returned is 15 lakh. So what happens when the assessment order, first reassessment order is passed? The assessing officer will say that the immediately preceding order is the order under 143. So there I have determined the income at 10 lakhs. Here I am determining the income at 12 lakhs. Therefore, the underreported income is 2 lakhs. He may, when he passes a second reassessment order, he will look at the immediately preceding order. Which is that immediately preceding order? It is the first reassessment order. So he will say in the second reassessment order, when I am levying penalty, I have determined the income at 15 lakhs. In the immediately preceding reassessment order, I have made 12 lakhs, and therefore the underreported income with reference to a second reassessment is 3 lakhs. So this is a quantification where there are multiple assessments and reassessments. Now this is a very interesting issue. I was telling you about the satisfaction. See, today section 271(1)(c) is very clear that the income tax officer during any proceeding before him, or the assessing officer or any authority mentioned therein, during any proceeding before him should be satisfied that there is concealment of income or underreporting of furnishing of inaccurate particulars. But as I told you, there is no concept of satisfaction inbuilt in section 270A1. All it says is that when you, during any proceeding before him, the specified authorities may direct a levy of penalty if there is underreporting of income. So the question here is that, is there a satisfaction needed? Should there be a satisfaction be explicit in the assessment order? As you are aware, earlier there are decisions which said that if the assessing officer does not record in the assessment order that he is satisfied that there is concealment of income or there is furnishing of inaccurate particulars, mere a direction to issue notice under 274 for penalty under 271(1)(c) is not sufficient. To get over this legal, this hurdle, the law was amended where section 271(1)(b) was introduced, where it says that even if there is any such direction is given, that will be equal to satisfaction. Simply saying issue notice under 274 or 271(c), initiate penalty proceedings under 271(c), or any other variation of this direction given by the assessing officer in the assessment order would amount to recording of the satisfaction. This is what 271(1)(b) says. So therefore, but that was based on the specific wordings of 271(1)(c). But 278 does not use the expression. But the question is whether do we still say that the assessing officer should be satisfied? In my view, there is an inherent requirement of satisfaction of the assessing officer. First, he has to satisfy himself that there is an underreporting of income. Secondly, he has to satisfy himself that such underreporting is either mere underreporting or a misreporting. So he has to satisfy himself on that. That's a very important point, that there has to be a satisfaction. Now, then second point is, as I said, that 270A1 does not talk about initiation of penalty proceedings at all. It only talks about a direction by the authority to levy penalty. Okay. But when it comes to the explanation B in subsection 2, in 270A subsection 3, it uses the expression if any penalty is initiated. See this. For the purpose of this section, in a case where an assessment, etc., converting a loss or converting loss into income, the shall be the difference between the loss claimed and the income or less, as the case may be, assessed or reassessed. See the preceding order definition. Preceding order means an order immediately preceding the order during the course of which the penalty under subsection 1 has been. So this is one interesting issue. 270A1 does not talk about initiation, but the definition of preceding order talks about initiation. So on my first point, that whether the levy of penalty under 270A should be in the, it will be along with the assessment order or separately in a proceeding later on, one can use this saying that it talks about initiation and therefore the assessing officer has a right to initiate the proceedings and levy penalty later. This could be one argument used by the department to say that the first proposition put forward by me is not right in law. It's a possibility. But here, look at this. The major difficulty is that when there is no specific reference to an initiation in 270A1. Suddenly that initiation concept is brought in the explanation clause A. So this creates some sort of a confusion, and this also requires a lot of thinking. This idea also can be developed and see whether it can be used as a technical plea for ensuring penalty is not levied. All these things are those cases where we are not covered by 270A subsection 6. Where we are covered by 270A subsection, we don't have to worry about it. But suppose we don't have a good case on merits, then we have to think of all these technical aspects on which the penalty can be challenged. This is one of them. Now, for the sake of argument, just for the sake of argument, I'm not saying that, let us assume that the courts hold that you have to record a proper satisfaction in the assessment order. Mere direction in the assessment order to say that please issue notice under 274 or for penalty under 270A is not sufficient. Because in this case, what happens is that the courts have earlier held that this is not sufficient and therefore there is no satisfaction. If there is no satisfaction, and in the absence of a similar provision under section 271(1)(b), the penalty can be quashed. This is on one assumption. That the assumption is that even under the section 270A1, the assessing officer must satisfy himself there is underreporting of income, and such satisfaction should emanate from the assessment order. If this is the position of law, then unless there is a very clear recording in the assessment order that this particular addition will lead to an underreporting of income or a misreporting of income, and unless such thing is recorded in the assessment order, penalty cannot be levied. So as I was telling you earlier that the subsection 4 and subsection 5 of 270A is applicable when you use an intangible addition made in the earlier years as a source for an investment in the subsequent years. So here is an example. I said I will explain this with an example. So I will do that. Here is the example. Let us say that for the financial year 1920, there is an investment of 5 crore. In the assessment year, sorry, in the financial year 1819, the assessment year relevant to assessment year 1920, there is an addition of 2 crore. In the for the assessment year 1819, that is financial year 1718, there is an addition of 3 crore. This is what has happened. And let us assume that for these 2 years, for some reason or other, the assessing officer has not levied penalty. On this 2 crore and this 3 crore addition, he has not levied penalty. Then during the financial year 1920, for the assessment year 2021, you have made an investment of 5 crore and the officer says you have not recorded this in the books. What is the source? You say this 2 plus 3 crores addition of 5 crores, which is an intangible addition which is available to me. I have utilized it for this investment. And therefore, I'm explaining the source, which the assessing officer accepts because it's a fact. Let us say that. So in such a case, what will happen is, for the assessment year 1819, because no penalty was levied, the addition is 3 crore. So therefore, he can go back to assessment year 1819, and in respect of the 3 crore addition, he can make he can levy penalty with reference to the 3 crore. Similarly, for assessment year 1920, which is the financial 1819 is the relevant previous year, he can levy a penalty on 2 crore. So this is what the sum and substance of 270A 4 and 5 are. But one important thing for this, but for both to invoke subsection 4 and subsection 5, it is important that the penalty was not levied in the earlier years. Another example, Let us say that in the investment in the financial year 1920 is 5 crore. Addition in financial year 2018-19 is 2 crore. Addition in financial year 2017-18 penalty is levied 4 crore. Then for assessment year 1920, that is financial 18-19 investment, he can do it on 2 crore. It's just a variation of that example so that you will understand the various situations that can happen. Now, I will take two issues on this before coming to the issue which is there before, because I have talked about the initiation earlier. I will talk about one more. Now, let us assume that because of the clause A, explanation B, clause A, which says that, which uses the expression when the penalty proceedings are initiated. So there has to be an initiation of the penalty proceedings. So unless there is an initiation of the penalty proceedings, penalty cannot be levied for any year, before, whether it's a current assessment year or earlier assessment year. Now let us take a case where for the assessment year, we'll go back to this slide. I go back to this slide, this 5 crore, 2 crore, 3 crore, etc., which I explained to you. He will levy penalty for the assessment year 18-19, that is the financial year 17-18, on 3 crore. But then the problem is that when he made the assessment for the assessment year 18-19, he did not initiate penalty proceedings for that year. So therefore, the question is whether he can levy penalty, even though subsection 4 and subsection 5 are there. You understand this subsection 4 and subsection 5 are nothing but a rehashing of the explanation 2 below section 271(1)(c) that has been rephrased and put into two different subsections. Now, in the context of explanation 2, the courts held that when you want to levy penalty for the earlier year because of the intangible addition, you did not initiate penalty for that year in the assessment proceedings for that assessment year, and therefore penalty cannot be levied for that year. So to get over that point section, that particular court decision, the law was changed and section 271(1) capital B was brought into the statute book. In 271(1)(b), what it says is that where an explanation 2 situation arises, the assessing officer can levy penalty even if for the year in which he wants to levy penalty, no penalty proceedings were initiated. There is absence of similar provision in 270 capital E with reference to 270 capital E. So even if I say that in this example, please levy penalty with reference to financial year 17-18, that is assessment year 18-19, in respect of 3 crores. Sorry, sir, you can't levy penalty because you have not initiated penalty proceedings, and you can't initiate it today because that assessment is over. So this is the issue which happens. So because of this, what happens is that there is a lacuna. This is another important point which you should keep in mind, that in case a subsection 4 and subsection 5 situation, this is only for that. It is not applicable to any other section. It is applicable only for 270A4 and 270A5. If any of these things happen, you have to ensure that the penalty is quashed on this ground. Another very ticklish issue is this. Now let us say for the during the assessment year 17-18, you say that I have used an intangible addition made for the assessment year 15-16 to make an investment. Officer accepts it. So he doesn't add that amount under the section 69 for the current year. Okay. So now, by invoking this explanation, invoking section 270A4 and 270A5, can he go back to assessment year 15-16? The answer is no. That is because very simple. Section 270A applies only for assessment year 17-18. So if you want to levy penalty under 270A for any year, you have to see whether that section is applicable for that assessment year. That obviously for the assessment year 15-16, no penalty could be levied. This is the point. Now, can he invoke explanation 2 to section 271(1)(c) for the assessment year 15-16 and say, I'm going to levy penalty under that? Now, that is also is a difficulty. That may not be possible because the explanation 2 uses certain expressions which we can use to say that all penalty proceedings have to be in accordance with this, in accordance with section 271(1)(c) only, but the satisfaction you reached is in with reference to a year for which 271(1)(c) is not applicable. So that satisfaction cannot be imported into 271(1)(c) and you can't levy penalty on that. So that's an important issue that can be done. Now we come to the important thing on 270(a)(6), which is a reasonable cause. As I said very clearly that 270(a)(6) or gives you a lot of leeway to say that penalty cannot be levied. Some of the few issues we can look at is if the books of accounts are rejected and the income is determined on the basis of rejection of books. See here the method of accounting is not rejected. You get the point? The officer says I'm not rejecting your method of accounting. The officer says I am not making any disallowance, an extra disallowance because you made an estimate. Like in our example, I am not using, it is not 15% of the car maintenance, it is 25% of the car maintenance, which is for personal use, and therefore I'll disallow 25%. On this extra 10%, he can't levy penalty. That's fine. But here that is not the case. Here he says, I'm looking at your books of account. None of your entries are verifiable. Your books have not been maintained properly. The expenses are not supported by vouchers. Sales are not supported by invoices. You are not maintained stock book. So he has a valid ground for rejection of your books of account. And he says that I'm going to estimate your income at X percentage of sales. In this case, what will happen is this is not covered by 270(a)(6) specifically. So the question here is, if the wholesale rejection of books happens, not because of the rejection of method of accounting, can you avoid penalty? The answer is yes. You can go back and say that, yes, I'm not liable for penalty because it is a reasonable, it's a bona fide. I had prepared the books according to my understanding and my documents. You are not satisfied with those documents, and therefore this is a bona fide explanation for addition, and hence, even though you rejected my books and added some income, that cannot be treated as underreporting of income. And there are certain issues on TP, etc., which I think we will skip it for the moment because of the lack of time. Then I have told you the definition of misreporting of income in section 270(9). In 270(9), that what it says, the issues are these. Who has the burden of proof? Who has to prove that the addition represents the misreporting of income and not a mere underreported income? The answer is, it is the burden of the assessing officer to prove that it falls under any of those sections, and it is due to a mens rea, that there was an intention to evade tax, therefore it becomes a part of misreported income. This assessing officer to prove there is no presumption that there is a misreporting of income because of these additions. Okay, a few issues. So therefore, the fundamental aspect permeating section 270(9) is that there has to be a mens rea, because all of them talk about certain mental state like concealment, suppression of facts, not recording in the books of account, recording false entries. So all these things require a guilty mind. That is what is called mens rea, and therefore the burden of proof is on the assessing officer to say that I had a criminal intent or I had an intent to evade tax, and that is why this, and he has to discharge that burden. The another point is one of the issues in 270A9 is that if you don't record your investments in the books of account, it is supposed to be misreporting of income. Now, we have to take a case of an individual. That individual says that he maintains a book for his business only. In respect of all other things, he doesn't maintain books of account, his other personal transactions. He makes a lot of personal investments. He has savings from the business. He draws money from his business and invests in various personal investments. Is it required for him to record in the books, which he maintains for the business? The answer, according to me, no. The section 270A9, when he talks about recording of investments, it means that those investments which are necessary to be recorded in the books. So if you make an investment in the course of carrying on a business for which you are maintaining books, or in the course of having a source of income for which you are maintaining books, yes, then you have to record it. Otherwise, you don't have to record. I withdraw money from my proprietary concern and then invest in some shares or in FDs or other securities. Those securities need not be accounted in my business books, and if I don't account it, department cannot treat it as a misreporting of income. In the case of SDT or TP, international transaction, they say that a mere failure to report a transaction is a misreporting. But you must understand all this thing is that before penalty can be levied for a misreporting, there has to be an addition. So a mere failure to report an international transaction, but on examination of the transaction, the TPO or the assessing officer comes to a conclusion that no TP adjustment is required, there is no addition, and therefore there can't be any misreporting. Because as you have to understand one point, misreporting is a component of underreported income. Underreported income is quantified based on the assessed income and the income determined under 143(1)(a) generally. So therefore, unless there is a difference, there is no question of bifurcating them into underreported and misreported. So nobody can, no assessing officer can say you failed to report this international transaction and therefore I'm going to levy penalty. No. You have to ask him whether I have added anything because of this failure. If the answer is no, no addition has been made, then there cannot be a misreporting of income. Now we'll come to section 10, which is reference to calculation of tax on underreported income. Calculation of tax is like this. It's very simple. I'll take one. These are all from the examples given by the board in the circular number 3/2017, which is I also given the citation. You can go through that. It's very simple. It is not very difficult to understand at all. So what they say is that these are the basic figures. Return to income is 100. Total income determined under 143(1)(a) is 110. Total income assessed under 143(3) is 150. Total income assessed under 147 is 180. So these are the basic facts. So what happens when he passes the assessment order 143(3) for the first time? What is underreported income? Assessed income is 150. 110 is the income determined under 143(1)(a). So here they ignore the returned income of 100. So 150 minus 110, 40 rupees is the underreported income. Assuming this is not a misreported income, the tax would be 12 rupees, assuming this is a firm or a company where it's a straightforward 30% straightforward rate. So that comes to 12 rupees, penalty is 6 rupees. When he makes a reassessment, that income becomes 180. So here, what is the immediately preceding order as per explanation clause A to section sub 278(3)? The immediate preceding order is the normal assessment order made where the income determined is 150. So in the reassessment, the income determined is 180. In the immediately preceding 143(3) order is 150. The penalty, the underreported income is 30. Tax is 9. 50% of that is 4.5. Then the other one which I have to explain to you is the one where the case of individuals, what happens when you file the return, when you don't file the return. Now, this is what the board circular says. It's a case where no return of income has been filed by a return assessee. So he has been assessed at 10 lakhs. So here's the case where there is no return. When he says it's 10 lakhs, 10 lakhs minus 2,50,000. Remember, the quantification of underreported income says that from the assessed income, you reduce the maximum amount not chargeable to tax. So if that is being 2,50,000, it comes to 7,50,000. But then what they say is this underreported income should be increased by for the purpose of calculation of tax by the maximum amount not chargeable to tax. This is a very convoluted method of looking at the tax on underreported income. They could have simply said that in the case where you don't file the return, the underreported income is the assessed income. But they don't say that. So here what happens is it is 7,50,000 plus 2,50,000, 10 lakhs. On that, the tax, etc., is 1,25,000, and you will pay 50% of that is 62,500. This also we have in a case where an addition is made on a person of 10 lakhs, a returned income. So even if an addition is made 10 lakhs, finally the penalty amount will be 62,500. So this is what happens. So this is a very interesting issue on this. that in the case of an individual, you have to read this example very carefully and understand that. It is not straightforward on you calculate the tax on underreported income. And the example in the respect of a loss they are given, this also is not difficult to understand. I won't much of your time on this. Since almost we are at the end of this one, I request the chairman to give some time to the participants to ask questions.
If you can remove the slide, thank you, I can unmute.
Pardon?
If you can remove the thank you.
Yeah, I'll stop sharing. Yeah.
Otherwise, I can't unmute. That's.
Yeah. It's okay now?
Yeah. So, gentlemen, we have had a strenuous session. I must really congratulate Ramasubramanyam for having taken us through the various sections. Before I give my concluding remarks, I would now like to hear from the participants the questions that they have to ask in this direction, and Ramasubramanyam and me will try to solve it to the best of our ability. So the
One
question,
rider, please. Sorry, one rider.
Yes.
You please remove if Ramasubramanyam from that. Mr. Devidas will answer all questions.
Hello.
Yeah.
But the participants will not agree, Ramasubramanyam, because you have taken them through so many issues. You said Devidas is only a silent mute. The chairman's role is introduction, conclusion. In between, what happens is between you and the delegates. Therefore,
Sure,
on this count also is overruled. Okay. Gentlemen, the floor is open. Please. See, unless you people ask questions, the issue will not be developed. Please go ahead. First question, which all of you I would like to ask is whether this order of penalty is appealable.
Yes, it is appealable because it is under Chapter 21 and Section 270 246A says that any order under chapter 21 is appealable if you want
No,
specific
there's
section.
no need to
Okay.
make a reference. So it is appealable once you say you are the paper writer. So I also agree with you. Although under 246A it is not specifically mentioned section 270A, since it falls under that particular chapter and there is a reference to 246A to that chapter, it is appealable. So both orders are appealable. It's not
Okay.
as if the order is not appealable.
Yeah, order is
Yes.
definitely appealable.
Yes, gentlemen. Yes, next question. Any other question?
Yeah,
I
there is one
started the
question.
ball rolling. Yes.
There is one question which propped up, but it went away.
Yes. The
Mr.
question
Rajesh
was,
Agarwal.
Yes, sir. I'll read the question.
please.
Yes, sir. There are some questions in the chat box.
Yes.
Yeah.
I'll read them, sir.
Right.
Yeah,
Okay.
please.
If the AO has disallowed expenditure on estimate basis, say 5% due to proper bills are not produced for his verification, and the same were accepted by the SSE, can the AO levy penalty on the addition made on estimate basis?
See, the question is on this issue, my answer is this. If you look at 270A subsection 6, there is no specific subclause dealing with the situation of an estimate of disallowance of an estimate of an expenditure not supported by vouchers or something like that, which what the query is referring to. But my point is, you can always go back to clause A of 270A6 and say this, your claim was bona fide and the officer is not satisfied with the documentary evidence produced by you. Since he has only taken a different view and it does not amount to any intent to evade tax, etc., you can take the Reliance Petro principle laid down by Supreme Court, saying that making a bona fide claim and a disallowance of that will not amount to concealment will apply here also. So you can take a stand that it is not liable, and this, if the AO doesn't agree, I'm sure at appellate level they will agree.
I will only supplement that. I'll only supplement that. One area is once he has estimated the income, where is the question of concealment? He's not pinpointing anywhere where have I concealed or where is the question of that is one aspect. He is only estimating. And he says the books of accounts are ordered, but is not in a position to deduce the income, the profits and gains. And therefore, he is saying that penalties will not be accessible under such. In all such cases, for underreporting, please introduce an element of rejection of books to the assessing officer. If the books of accounts are rejected, and please don't make the mistake of filing an appeal, because some CIT appeal 6 here will enhance the income. So whenever you are estimating the income, weigh the pros and cons before you file an appeal. Once it is estimated, there is no finding of concealment and your explanation is bona fide. I've kept all the books of accounts, I've produced the vouchers, but you are still estimating because the vouchers are self-made. 5% of the vouchers are self-made out of 100%.
Can we go to the next question? Yes,
Please.
What is the difference between income reassessed and recomputed as mentioned in clause B of section 270A3?
Basically, this is a historical, this one. If you look at section 147, it uses the expression that there is an escapement of income, or under 147, you can say that the income is reassessed or recomputed. The technical explanation for this can be that where already an assessment has been made earlier, there is a reassessment. Okay, when he does it under this. The income recomputation happens, especially in the information cases under section 147B, is that your earlier income is recomputed, but practically or even legally, according to me, there is no difference between income reassessed and income recomputed. Normally, recomputation is with reference to some depreciation, etc. they use. But other than that, but this is a hangover from the expression used in section 147 that has been brought into section 270 capital A. I don't think it has any practical this one. If Devidas can throw some light, I would be very happy to hear him.
Now, this recomputation, when does it come? Now, let us take a notice under 154. There is a mistake apparent from record and the income computation is not being done correctly. Now, that is recomputation. Take 263 order. The order is correct. Everything is correct, but it is prejudicial and erroneous to the interests of revenue. Then there is a recomputation. On the contrary, if there is income escaping assessment, an assessment has already been made. By virtue of this 147 notice, the income is being reassessed. That is where the distinction between recomputation and reassessment falls. So recomputation is on this particular limb and this is on this particular limb. There is no question of any reassessment as such. 154, what they are doing, there is a mistake apparent, right? Income already assessed, we add back this. So there is a recomputation of income. Next
This is a
question.
very interesting issue, whether, and when an addition is made in section 154, whether that penalty proceedings can be initiated at that point. This is a new point which I have not thought about. Thanks for bringing this point. I'll apply my mind and take it, see what view can be taken on that.
Yes. Now, next question, please.
Yes, sir. If a notice issued by a AO for penalty along with the assessment order and the assessee has paid an advance tax levied within 30 days and represented not to levy penalty, within what time the decision of the AO has to be informed whether to levy or not to levy penalty?
Now, once you make, yes, it is there in the act itself. It is there in the act itself. Once you go to give all the necessary details, he can, within a period of 30 days, he has to again inform you that he is dropping the penalty. But one aspect,
So he is bound to drop.
He has to drop because it's a statutory provision. Now, let me tell you one aspect here. The assessing officer, having initiated penalty proceedings and also accepted your application 270AA, he cannot later come to a conclusion there is a case of misreporting and not underreporting. Because once the process of 270AA is set in motion, he cannot alter any of the other issues.
See, while exercising his discretion under section, or not discretion, while finally taking a decision on 270AA, he can examine whether the additions are mere underreporting or misreporting. If he comes to a conclusion that it is misreporting, then he will reject your application. Secondly, even if it is underreporting, if he finds that you have not paid the tax or by mistake you have filed the appeal, then he can reject it, saying that these conditions are not satisfied. Only under these conditions he can reject your request for immunity. In all other cases where you have not filed the appeal, where the addition does not represent a misreporting of income, you have paid the tax and interest within 30 days, the assessing officer has to pass an order within 30 days of your application granting you immunity. He has no discretion in this matter.
Yes, Mr. Dahima, you have raised your hand. What is it?
No, not for any doubt, sir.
Okay, right. Yes.
Okay.
Next question.
Next question. Yes, sir. If the SSC opts to pay tax on some grounds of addition and opts to file appeals for some other grounds, what should be the position?
No, not pick and choosing of grounds is not permissible. He has to give up his right to file appeal. That's very clear.
Yes.
Next.
Voice is breaking.
Filed or not?
Yes, please.
Your example
Yes.
showed taking income of rupees 1 lakh and 3 lakhs.
Pardon? Oh, sorry, can you come again? Yeah.
Any penalty be levied? Is filed. Example showed taking income of rupees 1 lakh and 3 lakhs.
I'm not very clear about this question.
Hello?
Can you repeat the question?
Okay,
Can you repeat
I
the
will take it in the last. Yes, sir. If total income assessed is below 5 lakhs, can any penalty be levied? Whether return is filed or not, your example showed taking income of rupees 1 lakh and 3 lakhs, sir.
No.
Now, if your income is... Yes, please. Yes,
Yeah, you go ahead, Devidas. Right.
No problem. Please go ahead.
No, the point today is on 5 lakhs tax is payable. Okay. on 3 lakhs.
The tax is not payable. Basic exemption is 5 lakhs.
No, okay.
It's a super senior citizen.
In the example I had given, it is 2.5 lakhs
Yes.
was the basic exemption. That is
Correct.
why. So if you let, just check if it is below 5 lakhs, there is no question of levying penalty at all. 5 lakhs or less than
Super
that, there
senior
is no
citizen.
tax. There is no issue.
It goes on the presumption the assessee is a super senior citizen.
Okay, fine.
Above 80 years. Right.
Correct.
Then
Next
the
question,
question of yes, please. Next question.
Yes, sir. If in TP order, derivative issue are reported as not disclosed as a TP transaction, can any penalty be levied?
Now, yes. Yes, Ramu, please go ahead.
See, there are
Prerogative is yours.
Sorry. There are two issues on this. See, when you come to 270 capital A, okay, the non-disclosure of the derivative transactions, which is presumably an international transaction, should lead to an addition to income. That means your derivative transaction with your AE is not book value is not accepted, and some other value is substituted, and then the officer says that yes, I'm going. TPO says this is the addition you make. Then in that case, the penalty is leviable because you have not disclosed it. Okay, because that amounts even to misreporting of income. But there can be another issue. What happens is that you have not disclosed it, but during the TP proceedings, you are able to establish that the book value of transaction is at ALP and the TPO does not propose any ALP adjustment. He accepts your book value, in which case 270A will not come because there is neither an addition on this account, so there won't be any underreporting of income or misreporting of income on this issue. But there is another section which says that when you do not report an international transaction or a specified domestic transaction, you are liable for penalty up to 2% of the value of the transaction. So that is a different issue altogether. So that is for non-disclosure of a transaction, but that is not a penalty under 270A. For penalty under 270A to happen, there has to be an ALP adjustment. If there is no ALP adjustment, no penalty.
Done, sir. Next question. If TP officer makes adjustment under regular clause of the Act and overlap with the power of the regular assessing officer, what clause it would be dealt in?
See, the first question is that the TPO's jurisdiction is only to determine the arm's length price of an international transaction or a SDT when the assessing officer refers. He cannot go beyond the reference normally, but he can go beyond the reference if he comes to know that some other international transaction has not been referred to him or some other SDT has not been referred to him, and during TP proceedings, he has no jurisdiction to touch any other matter in your assessment. That is the sole preserve of the assessing officer. So if it makes any addition like this, it will be beyond jurisdiction. For instance, there are decisions which say that a TPO can't even ask you whether the services have been rendered or not. Once he has to go, once the assessee says that this is a service, he has to go on the presumption that the services have been received and determine the ALP. It is for the assessing officer to know, to find out whether you have really received the services, whether transaction is bona fide or not.
Yes, Nagesh, you seem to have raised your hand. Any question? Nagesh, you seem to have raised your hand. Yes, Ritesh, proceed.
No, sir, continue, sir.
Yes, please tell me.
Yeah, the next question. Is false entry defined?
False entry has not been defined in this section 270A. False entry, as you know, has been defined only under 271 AAD. So the false
That's
entry
a new provision.
Pardon? Is a
No,
new provision.
yes, it's comes only from 1/4/2020.
Exactly. So the false entry, that definition cannot be imported into the definition of false entry in 270A subsection 9, because the false entry there is the interesting issue, which I did not discuss because of the lack of time, is that can two penalties be levied for the same offense? False entry is subject to levy under 270A9. False entry is subject to levy under 271 AAD also. If you look at section 271 AAD, it says notwithstanding anything contained in any other section. So that is a separate, it is overrides other sections. But then one can always take a view, or rather from the department's point of view, they will argue something like this. There is no double penalty on the same offense. What I am levying under 270A is on the character of a misreported income. Whereas under the 271 AD, I am levying penalty for you carrying out an act like making a false entry in the books. And basically, as 271 AD says, the whole purpose of that is to complement it with GST provision, saying that if you get any bogus invoice and account it and claim the input tax credit, it was that provision. But unfortunately, the way the section is worded in 271 AD, it is much broader. So that is the question we have to ask ourselves. Is it the penalty under 270A and the penalty under 271A or on the same transaction or on the same subject matter, or are they on two different aspects of a transaction?
Now, when there is a special provision to levy a particular penalty, it cannot be levied under any other section. So 271 AAD will override the other sections is one way of looking at it, summarily.
Yes.
Now next question is, can any of the deemed incomes 68, 68A, 69, 69A, 69B, 69C cannot be brought under these sections because there is a separate section 115B, BBA, 271 AAC which deals with them. So even if there is any addition in relation to that, and mind you, that is taxed at 60%. All those deeming sections, if you don't explain, is taxed at 60%. So therefore, this one has to bear in mind, if they fall under different sections, it cannot come under this section. That is one aspect.
Unlike section 271 AAC, etc., which deals with the computation of income, 271 AAD has nothing to do with the computation of income. It is mere recording in the books of account is sufficient, a false entry. So that is where the conceptual difference arises, because here 68, 69, etc. forms part of total income, and that portion of the income is being levied penalty at a separate rate. But
now
Devidas is right, saying that addition to 68, 69, etc. cannot come under 270 capital A.
Now, another aspect is 271(1)(c). Mr. Ramasubramanyam rightly brought out the distinction that in the course of the assessment proceedings, the assessing officer should be satisfied, etc., etc. But if you look at 270A, no satisfaction, they have to come to a conclusion. So there is no question of satisfaction, they have to come to a conclusion. The only thing is, under reporting, you are given an opportunity to explain, and you may say it is bona fide, etc., etc. Whereas for misreporting, there is no such opportunity being given to you. So therefore, there is violation of principles of natural justice here, because without giving you an opportunity and considering your explanation, they are going to levy penalty for misreporting. Whereas for underreporting, an opportunity is given, you can establish your case, you can say it will fall under the exceptions. Whereas for misreporting, there is no such case. Still, you can bring in the principles of natural justice to say it is so. I am told that writ petitions are pending in the Bombay High Court on this particular issue.
Mr. Devidas, I will have one slight different opinion on this.
You are keen to close by 5. Now you are extending. Okay, please extend. Come on. right. Please. Come on. No problem.
Okay. See, the point here is, once you assume that the separate penalty proceedings have to be initiated and then order passed, even for misreporting of income, he has to issue notice under 274. And then you have to give an opportunity of being heard. See, what happens? The penalty is on underreported income only. Okay, what they are doing, they are making a distinction between underreported income and misreporting of income only for the purpose of quantum of penalty. They say if it is underreported income, it is 50% of tax on underreported income. If it is misreported income, it is 200% of tax on misreported income. But both the things fall under the broader definition of underreported income. So therefore, once the assessing officer comes to a conclusion that penalties be levied, he has to issue a notice under 274, and in that notice he must say very clearly whether he wants to treat it as a mere underreporting of income or he wants to treat it as a misreporting of income. Suppose he does not give you, saying that I want to treat it as misreporting of income, then in the final penalty order, he cannot treat it as a misreporting of income. That will be violation of principle. That is my view.
Okay, that anyway you only supplemented, not differed from it. Okay, now another issue is this immunity under 270 AA is available only where an assessment is made under 143.3 read with 147, but 144 assessments will not get this immunity. An assessment made under 144. So if the client has been negligent, the object here is if you have been negligent in not filing the return of income and throwing yourself to the process of assessment, you will not get this immunity. So immunity fails whenever there is any 144 assessment is concerned. Now, lastly, I may also tell you, in respect of these issues, suppose the I 270 AA, I have missed the bus, let us say. Now, when I go in appeal, I filed an appeal against misreporting. The CIT appeals is convinced with my submissions. He says it's not misreporting, it is underreporting. So therefore, can I come back to take the immunity?
So you are, no, let us be very clear on this. This is a very interesting issue. Now,
I could not avail the benefits
no,
of immunity provisions because it falls under misreporting according to the assessing officer. He did not give me that chance.
No, let us
When
be
I
very
went,
clear.
yes,
See, what happens is 270 AA procedure is before levy of penalty. Okay, so let us assume that your case may arise in a case where he has issued a notice in 274 and he says it's a misreporting of the income. And
he has not yet levied the penalty.
But he has not levied. Obviously, he wouldn't have levied the penalty. So this could be one case. So in which case you feel that since he wants to treat it as misreport income, you don't even file an application 270 AA.
I could not file at that time because he said it was misreporting.
Yeah, because he has issued
CIT appeal says it is underreporting. Therefore, the gates of the immunity should be open to me.
Fine. So therefore, when you go to CIT appeals and say it's not misreporting, the question here is that there are two ways of looking at it. Since it's a waiver clause, somebody will say that the Supreme Court nowadays is taking a very unreasonable stand, saying that you have to comply very strictly with all these things, etc. And therefore, we will not allow because it's a waiver clause. The other point is that I was prevented by the assessing officer who has taken a wrong decision.
Correct.
So, but the procedure to remedy this may be by way of a writ petition in the High Court and getting a direction.
Correct. We have to file it, resolve it only by way of a writ. I admit. Now, after all this is over, there is one section 273 capital A where the commissioner can reduce or waive the penalty, which is to be imposed or imposable. So you can go to the commissioner even before the penalty is levied. 273 capital A, 270A also is covered.
Yes.
The only condition there being is it should be voluntary and in good faith. If all these conditions are, but I am not very sure, this 273 has been only in the statute book. Let me tell you, practically no commissioner has waived or reduced the penalty. They have only sat over it. Now, of course, the period of limitation is there within 1 year. But what I am trying to say is there's one more avenue under 273A. The only ground is you should not have filed any appeal and you should not have availed of the benefits of 273A in the past. But there is no statistics with the department whether A or B has availed these provisions. 273 also is open. Voluntary and good faith.
But you
what
remember,
is voluntary? Yes.
Before 1989, 273 was also there. At that time, the commissioners were exercising the discretion in levying penalty, were withdrawing, the dropping penalty. Earlier regime, the commissioners were more fair.
That was akin to Ashoka period. Maybe that time the departmental officials were more little, but now let me tell you, nobody wants to take any action on this.
Now
So
you don't even
therefore,
get a relief from
that
CIT
is,
appeals.
yes, that has been only on the statute book as such. So I would now request the organizers, if there are no further questions, you may kindly
Two
thank.
questions are there, sir. If you want.
Yeah. Tell me, please proceed.
Yes, sir.
Please.
As
Yeah.
per section 270A to E, amount of deemed total income assessed as per 115 JB or 115 JC is greater than maximum amount not chargeable to tax. There is no basic exemption limit for companies. Kindly explain.
That's what I have. If you see my slide, I have taken this issue, but I didn't explain that. But see, the question here is obviously that particular basic exemption clause cannot apply to a company or a firm. And I do agree that 115 JB applies only to a company. So therefore, it can't. Even 115 JC may apply to a firm, but 115 JB does not apply to anybody other than company. And therefore, the reference to 115 JB is not correct there to a certain extent. It is redundant. Actually, that the 115 JB clause will not apply because of the maximum limit is not applicable to company. The company is liable from rupee 1.
If anybody has got a letter pad or pad to note down, please note down this illustration vis-a-vis a question. Income assessed in the hands of under normal provisions 7 lakhs. And then the addition made is 9 lakhs. Normal provisions, so therefore the adjustment made will be 2 lakhs. Now come to the normal provisions. The book profit is 18 lakhs, assessed is 19 lakhs, 1 lakh. So there's 2 lakhs here and 1 lakh here. So the penalty will be levied on 3 lakhs.
Correct.
So we cannot say that you'll get away with 115 JB, you levy only on this, because the Supreme Court confirmed the decision in Navla and Sons of the Delhi High Court, where they said even under 115 JB penalty can be imposed. The statute was amended. Therefore, if there is an adjustment to 115 JB as well as under the normal provisions, both have to be aggregated, but the rate of tax may be applicable will be different, but the penalty is imposed. Yes, next question.
Yes, sir. Does a tax auditor become liable under section 271 AAD when the AO proceeds against the SSC under 271 AAD?
Now, as far as this question is concerned, in our enthusiasm to do the tax audits, all the SSCs come on the last day or last week of September, as the case may be. Now, whenever you do an audit, neither your people nor the article trainees put any entry in the books of accounts in their handwriting. Now, what happens is on 31st March, partnership firm salary entry is made, or some outstanding expenses debited and credited without looking into the nuances. We are in our enthusiasm, we make that entry because the accountant leaves the books and goes. We also perform that duty also. You should not, because any false entry there, the tax auditor. Now, what the SSC will say, I didn't know anything, sir. If I knew everything, why will I go to Mr. Devidas? Devidas told me to pass that entry. I did it. So therefore, you should not involve in making the passing of the entries. So the false entry, you are in no way concerned because the falsity has not been brought to your notice. We do not know what it is. We are not doing an investigative audit. So therefore, the question of falsity and your culpability will not arise.
Yes. We are done with the questions, sir.
Questions are over?
Questions
Okay.
are over, sir.
So, see, I must thank Ramasubramanyam. First, he said close at 5. You see how enthusiastically he went on far and far. He's prepared to answer any number of questions now. That is where Ramasubramanyam stands apart. So, thank you, Mr. Ramasubramanyam. Now, I leave with the entire proceedings to the organizers to terminate the whole program.
Before you start, I just want to make only one point. I want
not on the questions, no, because subject is closed. I can't reopen.
Not on subject. I want to thank you. Please allow me that.
Okay, right.
Don't differ on that.
That you can do. That you can do. You can take your own time. No problem.
The problem with Devidas is this. Whenever he hears my voice, the first thing he wants to contradict. Then he will say, "What? Let me listen to it." Anyway, I want to thank each one of you for the enthusiastic participation you made, the questions you have asked, and also the issues you have raised. So that has interested me a lot. I want to thank again your association for giving me this opportunity to discuss the issues and also have a lively personal discussion with Mr. Devidas. Thank you very much.
So now we thank you, sir. Thank you so much. And
And I would request the organizers to take these things forward. You are doing a good job, the Tax Bar Association, but it don't take vast topics. You will not have now. See, you picked up 270A. Correctly, you picked up full threadbare exam. Again, go to 271 ASC. Discuss only 271 ASC. Leave the search assessments and all that later because that is for the people to take care, or that can be taken in the end. Because primarily, most of the practitioners today would like to know what is 270A, how is the penalty to be.
Answer it.
yes, sir. Thank you so much, sir. Thank you,
Thank
Ramasubramanyam, sir, and Devidas, sir. On behalf of Tax Bar, I request Naima, our treasurer, to propose a vote of thanks.
Hello, everybody. Respected Session Chairman Shri K.C. Devidas Garu and our distinguished speaker of the day today, CAC S. Ramasubramanyam Garu from Bangalore. Respected President Shri A. Sri Ramdevji Bhutra and my dear professional colleagues. It gives me a great honor to propose the vote of thanks to all my dear senior members, friends, and colleagues in making such a resounding success. First of all, I would like to propose hearty vote of thanks to respected Session Chairman CA Sri K.C. Devidas Garu, past President of our Tax Bar, for gracing today's seminar. Thank you, sir, for your very interesting and thought-provoking address. I would like to thank our distinguished speaker of the day, CA Ramasubramanyam Garu, for making a presentation in making this seminar interesting and very, very meaningful. I am happy to express my vote of thanks to all our esteemed fraternity, tax bar members, association members for making this online seminar a great success. I request you all members interesting and will be provoking in our future professional communication and correspondences. Thank you once again on behalf of Tax Bar and Telangana Andhra Pradesh Tax Bar Association for making this seminar a great success. Thank you all. Namaste. Jai Hind.
Thank you, sir. Thank you very much. Thank you.
Very much.
Thank you.
Yeah.
Thank you, sir.
I can leave the meeting.
Yes, sir. Yes, sir.
Yes, sir. Thank you, sir. Ramasubramanyam. Thank you, Andy.
Thank you very much, Andy.
Thank you, Ramesh. Thank you, Devidas. Namaskaram.